This is our second part in our three-part recurring option series. This is intermediate options. We did the basics last week, which is really just an introductory to options, and we will do advanced strategies next week. We are recording this. It will be available this afternoon for your review. The session should last about an hour and 15 to an hour and a half. Today, the intermediate session is the longer of the sessions because I try to pack in a lot. So with that, and already a minute or two or four late, let's rock and roll. Quick thing, but before we do anything, nothing I say counts as advice in any way, shape, or form. Options are risky. Please consult your financial advisor. With that, I've been trading options for a while. I have been coached by some very impressive folks. I've been blessed to be coached by some very impressive folks. My job here is to help subscribers match good strategies with good stock strategies, with good option strategies, and put them together. Right. One of the things I find that hurts a lot of options traders is they don't really have a direction on the stock. When you have an understanding of what direction a stock is likely to go, it really helps your options trading. So today we're going to do a quick review of what we did last week. And I mean, quick. Then we're going to do implied volatility, liquidity. We're going to talk about the Greeks. After we go through all of that, we're going to get into single directional options and vertical spreads, both debit and credit. We'll talk about why we recommend, I don't know what a wide spread is, what counts as a wide spread, but we can look at some. And we'll talk about why you would want to put a spread more narrow or more far apart, whether it is a credit or a debit. So we will get into all of that. Last week we talked about option basics, and everything we do in options, this is the foundation that you're looking at right now. These are the 4 basic actions that you can take. There are no other actions in the options market other than these actions. This is it. These are the only 4 actions you can take. Now, you can take these actions in combinations, and we're going to talk about that. As a debit vertical is where you buy a call and sell a call. So we will talk about doing those at the same time. But all of that really just is based on these 4 actions. So all vertical spreads, butterflies, condors, they're all just combinations of these. If you can understand these, get your mind around these, you're way ahead of a lot of options folks out there. Generally speaking, your debit strategies have higher reward, lower risk, and less odds of success. Again, generally speaking. Your credit strategies, because you get paid up front, and it has to go against you a certain amount in order for it to not be profitable. That has lower reward, higher risk, but it has better odds of success. Credit strategies tend to have better odds of success. Generally speaking, debit strategies are going to be less than 50-50. Credit strategies are going to be better than that. And so if you look at the probability of profit on our platform in the option widget, you'll see most debit strategies, higher POP, most debit strategies, lower POP. We talked a little about risk and reward basics, understanding where your break-even number is. If you buy, you need to overcome the premium before you get to your break-even number. Everything above that is profits. If you're a seller, though, you taking your money up front, the break-even is exactly the same. We talked about this last week. It is a zero-sum game. If you buy a call and you make $1 on that call, somebody lost $1 on that call. So it's a zero-sum game. What your option is making, someone's option is losing. When your option is losing, someone's making it off you. Now, we typically look at options like this. This is the way that we look at profit and losses. We don't, you're not going to see this anywhere. This is something that I just created for educational purposes. But we will see this quite a bit. You'll see what are known as profit and loss charts for options. So your profit and loss is graphed on the y-axis vertically. Right? You'll see that there is a 0 line, and that is the difference between making and losing money. There's your 0 line on that side. Here's your 0 line on this side. Profit and loss vertically. Now, the price of the stock, that is graphed horizontally. So when a stock goes up in price, that is this direction, moving down in price this way. So you see when you buy a call is bullish. When the price goes down, you lose money. And when the price goes up, you make money. The loss over here, as I said before, is the gain over here. This gain is this loss. They're exactly the same, to the penny. And that's typically how we look at these. And so you can get a sense of where is my break even? How much risk do I have? You know, what's the profit and graph look like as price moves? Now, there is a curved line on here. The curved line represents today. Where would we be if we got out today? And these angled ones are at expiration. And for a put, we look at it the exact same way. It's just flipped around. Again, these very angled lines here, all right? So the one that's going up on an angle here, that fixed one, and down on an angle, that's at expiration. This is your break-even point at expiration. And the curved line tells you profit or loss for today. What happens where we move today, right? We'll talk about profit and loss recommendations in a little bit as well when we get into the examples. That's a great question. People should have profit examples or profit targets. 50%, we'll talk about that in a little bit. Stick with me. All right, let's look at an options chain. There's a lot of numbers on this options chain. I pulled this from my Fidelity account. You'll see that the strike goes right down the middle. That's where the strikes are. The calls are on the left. The puts are on the right. There's a lot of details in here. I could have added more columns. My platform allows me to add all the Greeks in, all kinds of things. But it's quite a bit. And you'll see that they're shaded areas here, as we talked about last week. That's how we know where in the money is. So these are our in the money options. Again, calls on the left, puts on the right. It lists for you what the last price was, the change on the day, the bid and the ask. Now you'll notice these bid and asks are rather close. We'll talk about what is an appropriate bid-ask spread. Volume and open interest, implied volatility and delta. Now you can change all these a little bit. Mine has an action button here. Yours may not. That's just I can click on this and it gives me the chance to buy or sell, open or close. All right, and strikes down the middle. Let's talk about this options chain in individual parts, though. So let's first talk about open interest and volume. Open interest is the number of active contracts currently in the market. So if I bought a contract yesterday, open interest would go up 1. And yesterday, it would show 1 contract as the volume. Now, if I'm still holding that contract today, the open interest is still 1. However, volume resets back to 0. Volume tells us what happened today, only today, number of contracts happening, trading today, opening or closing. Open interest tells us how many open positions are out there, how many active contracts are out there. All right, and it gives us a sense of liquidity. And you shouldn't be in things that have very low volume or open interest. Now, this that I showed you here is the options chain for the SPY, the S&P ETF. It is the most liquid ETF and option chain. So I don't want you to think that you go to your, you go to buy Apple options and you see, well, Apple's not trading 140,000 contracts or 3,000 today, and go, oh no, it's not enough. That's not true. You should have a set. I am a little more aggressive than most. If there's some open interest and a little bit of volume, I'm happy. I think for most people, you should see open interest maybe in the hundreds as you're getting started is a good place to get started. Okay, if the open interest is really low, you have risk of finding a counterparty. A lot of stocks are very, very liquid, and I think people take that concept over to the options market, and not all options are very liquid. And so what people sometimes have happen is they don't think about the exit. Remember, if you buy a contract and you want to take your profits on it, you have two choices in the options market. You can sell to close that contract. In order to sell to close that contract, you need somebody to buy it off of you. Every seller needs a buyer, every buyer needs a seller. And if there is no volume and very little open interest, when you have your profits and you're ready to get out, there may not be somebody on the other side to take that contract off your hands. So you need to have a certain amount of volume and open interest. Otherwise, you have exit risk, the inability to get out at a reasonable price to exit. The other way to do it is you can just exercise the whole thing. Exercising it can be a pain. You need to convert it to shares there, which means you need to have the money in your account to cover 100 shares of whatever you're trading. May not settle immediately. You also lose all the time value, because when you exercise, you get it at the strike price, and you lose all the time value that you may still have remaining. Any volatility priced in, you lose that too. So it's important to have good liquidity, especially for new options traders. Now, one way we measure it is by open interest and volume. Another way in which we can get a sense of liquidity is by the bid-ask spread. Bid-ask spread is the buyer's price and the seller's price. So if you think about buying a home, when I went to buy a home, my wife and I said, we are bidding this much. We are willing to buy at this price. We are entering a bid. So the buyer puts in the bid. The seller puts the ask. The person who was selling the home said, no, I'm asking this much. And until the bid and the ask met, we were unable to buy our home. They said, we're asking this much. We said, no, we're only bidding this much. Until the two of us agreed, the trade did not occur. And that's what buying a house is. That's a trade. You're trading money for a house. No different than trading money for an options contract or money for shares. Same thing. So, bid and the ask. I encourage people to only trade options where the difference, the width of that spread, is only as wide as 10% of the ask. Okay? 10% of the ask. Yes, Gary, I will. So what do I mean? These are all very, very tight. You'll see that these are a penny or 2 pennies apart. Again, they're very, very liquid. That's very good, a penny or 2 pennies apart. When I look at options and I'm deciding whether or not I think the bid or ask is too wide, I do a quick little mathematical exercise. I look at the ask, I look at the bid, and then I look at the difference between them, what's known as the spread. And then I take the spread and I divide it by the ask. And it needs to be less than 10%. So if the ask is $1 and the bid is 90 cents, then our spread would be 10 cents. And if we take 10 cents over our ask, right, we take our spread of 10 cents and we divide it by our ask, which is $1, we get 10%. That would be acceptable to me. To be honest, I do a little bit wider sometimes. Again, I'm a more aggressive trader. I understand that there is exit risk. The wider the spread, the harder it's going to be for you to get filled where you want it to. Most times we recommend that you go to the midpoint and put a limit order by the midpoint. If it's a really, really tight spread, like you see here, only a couple pennies, a market order will work. Any market order you enter will be filled on the, I'll say the opposite side. So if you put in a buy market order, they will fill you on the ask. If you put in a sell market order, they will fill you on the bid immediately. Market makers play a role related to open interest. In fact, sometimes the person on the other side of your trade may not be some Joe Schmo like me. It might be the market maker. Market makers are tasked with exactly what their title is, making a market. They are supposed to provide liquidity within reason. Some of the people that I was taught by were market makers on the Chicago Board of Options Exchange floor. They're market makers on the floor for options, and I was blessed to be able to learn from them. And they'll take positions if they think it's reasonable in order to facilitate trades for clients. That will show up as open interest. If I buy it and a market maker fills it for me, they sell it to me. The market maker is short. I still have one contract will show up as open interest in that case. If I sell that contract then to somebody else, not the market maker, because there are multiple people out in the market, it's dynamic, and I close my position, and the other person is also, in their case, closing their position, then the open interest would go away. If I sell my position and the market maker buys it back, then that position, that open interest would go away. All right. So I could buy my position today from the market maker who fills it for me in order to facilitate my trading. They might have shares available that they can package up and bundle into a call for me to buy that they then sell. And so market makers, again, they provide liquidity. They're not just going to do it because you want to buy something, though. So market makers are not there necessarily to make sure you get filled. They are there to help fills in less liquid markets and to keep things orderly in fast-moving markets. So that's a little bit of the way that market makers work. You could be trading against the market maker. You're not always trading against some other Joe Schmo out there. You could be trading against a market maker who may just be doing it because they've been tasked by their broker, Schwab or Fidelity or whoever it is, to fill if they think it's within reason and they think they can profit off it or maybe not take a loss. A lot of market makers are working on big volume, so they have inventory, right? They have a set amount of options that they can put out or a set number of shares. There are market makers for your stocks as well. So I hope that answers your question, Gary. So again, the wider the spread, the tougher it's going to be to exit when you want to exit, and so you should shoot for tighter spreads. I recommend staying under 10% of the ask. All right, so spread less than 10% of the ask. That's what I encourage people to do. The wider the spread, the riskier the ability to exit at the price you want. All right, implied volatility, one of my favorite conversations. So we're going to take a few minutes here on implied volatility. First, we're going to talk about what implied volatility is and how we can quickly measure it. And then we're going to talk about how we use it, because I think it gets misused quite a bit. So implied volatility measures the expected move, what the market thinks is the likely distance a stock is going to move. So you could look at Apple and you could say, okay, I think Apple's might fluctuate plus or minus $5 this week. Or maybe it'll fluctuate $10 over the next month or $50 over the next year, plus or minus. Implied volatility is our way of measuring that amount. It's what the market is pricing in. It's the move you're paying for. Let's think about it like that. The higher the implied volatility, the bigger the move the market is pricing, which means you're paying for the ability to participate in what's likely a bigger move, or at least what the market is expecting to be a bigger move. Now, if the market is expecting a bigger move, they charge you more for it. So higher implied volatility means higher premiums. And we can measure that based on Vega. We'll talk about Vega in a little bit. Now, we can do a quick calculation to get a sense of implied volatility moves. The way to do it, and here's the semi-quick calculation right there. You take the implied volatility and you multiply it by the strike. Every single strike and every single expiration has its own unique implied volatility. You will see that the implied volatility for the 242 strike is not the same for any of the other strikes. And each strike has its own implied volatility. In fact, the calls are on the left, all the calls have their own, and all the puts have their own. Every individual option contract has its own unique implied volatility. And that's the implied volatility that you need to concern yourself with when you are trading options. You do not need to worry about the VIX. Okay? I'm going to say that again. You, generally speaking, if you are trading individual stocks, do not need to worry about the VIX. The VIX, widely commented on, measures a very specific volatility. It measures volatility at the money on S&P futures. That's what it measures. The implied volatility of at the money options front month of the S&P futures contract. So right now the VIX is telling you what the implied volatility is on the, I guess we would be still on December. We probably rolled to January on the futures. So any futures traders out there for trading the ES, which is S&P futures contract, the E-mini, they're rolled over to January. So the VIX is telling you what's happening on those. Now, if you're not trading options on the S&P futures, the VIX doesn't really have much to do with your individual stock's implied volatility. A stock's implied volatility is also a relative thing, and we'll talk about that in a second too. So you need to concern yourself with your stock's options implied volatility. Now, back to the quick calc. We take the implied volatility, we multiply it by the strike, and then we divide that by the square root of how much time is left. So I used 16 days because it's easy to get a square root of 16. So we took this implied volatility. All right, so we're using this as our calculation. 7%, so that calculates as 0.07 when we measure it, right? We list it as a percent, but mathematically it's 0.07. 7% is 0.07. Multiplied by the strike, 242. And then we took the square root of how much time is left. And I'm just saying there's 16 days left to make the math easy. We reduce those down. Those numbers become to this. We reduce that down. And there we get 4.235. So the 242 strike with a 7% volatility is expecting a move of 4.25, just about. So that tells me that the market is pricing in a move from 242 as high as 246.25 or down to 237.75, because the implied volatility is a plus minus measurement. So it could be priced up this far or down that far. That's what we're expecting. It's the expected move is a plus or minus when you calculate it. So it could be 242 plus 4.23 or 242 minus 4.23, and that's what gives us the difference. The expected move is displayed on the options screen, and we'll go over that in a second when we go on to the examples. I'll show you where you can find that in options play. I like to pull it off of my broker personally. Now, before we get into this, one last thing on implied volatility, and I do think that this is important. As I mentioned earlier, an implied volatility is unique to every individual stock. That is to say that the implied volatility on Apple's 175 call is going to be different than the implied volatility on Apple's 175 put or anything else, or Tesla's call or put, and each has its own unique range. Right? So the implied volatility, the normal range for implied volatility for one stock may not be the same as the implied volatility for another stock. That is to say, if someone says to me, well, the implied volatility is 50, that's high. My first question is, well, what's the normal range? Is the normal range 50 to 100? Because if the normal range of implied volatility is from 50 to 100, then 50 is pretty low. But if the implied normal range is 10 to 50, oh, then 50 is pretty high. You see, implied volatility on its own is I think George Carlin, the late comedian, said, is a half score. It's like telling you the Sixers scored 90 points last night. We're in Philadelphia, so we're talking about the Sixers a little bit. That doesn't really tell you anything, though. Did Golden State score 92 or they score 88? Makes a big difference. Makes a big, big difference in who wins the game. Makes a big, big difference in who wins the options as well. With debit strategies, you want low implied volatilities. With credit strategies, you want high implied volatilities. I'll say that again. If you are looking at doing a debit trade, you want low implied volatilities. You want to pay for a small move. Now, most people think that's a little counterintuitive. Don't we want a big move? Well, yeah, we want a big move. But if you pay for a big move and then you get a big move, well, great, you paid for the big move. You got what you paid for, right? But let's say you pay for a small move and then you get a big move. What happens then? Make a lot more money. Now let's think about the other side of it, because that's really where the risk is. And that's really where the issue is. Let's say you pay for a big move and then you get a small move. Now you're in trouble. But if you pay for a small move and you get a small move, okay, it's not so bad. So what I do is I look at implied volatility and I measure it against that stock's own implied volatility range. So let's do this real quick. There's another measure, so you can look at implied volatility, and there's another measure known as historic volatility. Now, historic volatility is what has actually happened. So it's also known as realized volatility or actual volatility, known as historic volatility. So I will do one of two calculations, which I think are acceptable. You can compare current implied volatility to the 52-week IV range. Or you can compare current implied volatility to the 52-week historic volatility range. Okay. Trying to take a screenshot of something for you guys, and it is not working as planned. And what you want, so in this, basically what I do is I say if the current implied volatility is in the upper third, I will not do any debit strategies. If the current implied volatility is in the lower third of that range, I will not do credit strategies. This keeps me away from from losing money on volatility. If any of you have ever played earnings and you bought a call a day or two before earnings, and then it made a move, a decent move, and you open it up, and the next day you see that you didn't make as much as you thought you'd make. It's probably because you paid a really high implied volatility right before earnings, and then when earnings came out, the implied volatility drops precipitously, and you're left with, um, not as much as you had hoped. So let's see if this works, because I do think this is a critical thing, and I'm willing to hold us up on just this. I think a lot of people overpay for their options. Inside of the platform, All right, let's just try this. All right, here we go. This is Apple. This is right off my Fidelity account. Down here, there is a graph, and it shows me two lines. One is the 30-day historic volatility. That's the blue line. The other one is the implied volatility average. And you can see the low end of the range for implied volatility is down here. And the high end of the range for implied volatility is up here. And all this kind of in the middle, right? Now, when we get to Vega, you'll understand a little better. Maybe you already understand Vega. If you buy a contract when implied volatility is up here and it drops 8% down to 17, you're going to lose money. So what I do is I look at where is our current implied volatility, and then you can compare it either to the 52-week implied volatility range, or I will sometimes compare it to the historic volatility range, which is what the stock actually does. All right, and for the past few months, you can see the range for the stock has been, the implied volatility, the actual volatility range has been somewhere around here. These are the lows. Somewhere around here, these are the highs. So I want to try and buy when the implied volatility is down in this area. I don't want to buy when implied volatility is up here. That's not a good time to buy the option. You're going to pay up for it, and it's going to hurt you. If you use Thinkorswim, Thinkorswim has something called the IV percentile, and they basically tell you in the range for implied volatility. And you can see this is Apple's normal range here. If I put in a different company, for instance, look at their implied volatility range. It's not 20 to 30. Now we're looking at 35 to 50. So I have to be aware of that. That's important to me, right? Because 50 for this is really, really high. It's the upper end of the volatility for Fizz. Also for Tesla. I thought Tesla would be higher. And look at this. Tesla's implied volatility is pretty low right now compared to its normal implied volatility range. So that means that you would want to do debit strategies in Tesla. This is not the time to do credit strategies. Credit strategies are best for when you're probably closer to the higher end of the range, somewhere up here. That's when credit strategies are going to be best. All right. So this is off the Fidelity platform. my individual Fidelity platform. I also have a Thinkorswim platform. Thinkorswim has something called Ivy Percentile, and basically they just tell you where is it inside of its 52-week range. If the 52-week range was 0 to 50 and the implied volatility right now is 49%, their Ivy percentile ranking is going to say 98. It's all the way up at the top end, right? It's a quick way to just give yourself a sense of where is the implied volatility relative to itself, not to the VIX. Okay? VIX could go up and the implied volatility on your stock could go down. All right. Implied volatility. Let's talk about the Greeks. Let's run through the Greeks. Delta. Delta tells us how far a stock is going to move when the underlying moves $1. So calls have positive delta, long puts have negative delta. Delta ranges from 0 to 1 for calls. It ranges from 0 to -1 for puts. All right. I should add that in there. And it basically tells us how much participation are we going to get for every $1 move in the underlying option. It's a quick way to calculate how much you can stand to make if a stock moves a certain amount. All right. So if stock goes up $1 and your delta is 0.5, the premium is $1. Well, when it goes up $1, the delta tells us the premium is going to go from 1 to 150, so on and so forth. Deeper you go in the money or farther out of the money you go, the more the delta changes. At the money is about 0.5. Right? So at the money deltas are 0.5. The deeper in the money you go, the closer you get to 1. The farther out of the money you go, the closer you get to 0. For puts, again, they're negative. Same concept though. The deeper in the money we go on the puts, the closer we get to -1, or the farther out of the money we go on puts, the closer we get to 0. Theta, time decay. All extrinsic value is subject to time decay. It is measured in dollars per day. It is negative for long options. It is positive for short options. So if you are a debit trader, theta hurts you. If you are a credit trader, theta helps you. It is not constant. The closer you get to expiration, the faster theta will decay. It's a little bit like wax to a flame. The closer you bring that wax to the flame, the faster it melts away. Same thing. The closer we get to the expiration, the faster the time value goes away. The quicker you lose your extrinsic value. All right. It is worst in the last 2 weeks. For my debit trades, a lot of them, I try to exit with a month left, and I often will buy a month more time than I think I need. So if I think a trade's going to take 2 weeks, I buy 4 to 6 weeks minimum. If I think it's going to take 4 to 6 weeks, I buy 8, 10 weeks. I try to buy 2 to 4 weeks more than I think it's going to take. And I try to buy a month more than I think it's going to take. And then exit with a month left. All right. If you had, I'm a terrible artist, so you're going to have to bear with me. But if this is expiration here, and back here is 90 days. And then we can just draw some quick hacks. So that's 90, we'll make that 60, and there's 30. All right. The amount of time that you are going to lose in these last 30 days is going to be less than the amount of time you're going to lose in the first 60. All right. The loss from here over is greater than the amount you lose from the first 60. The last 30 days, you'll lose more money than the first 60 on an at-the-money option. It really, really, really falls off quick. All right. So just be aware of that. If you're sitting in an option going, hey, I think maybe I can make a little more tomorrow, maybe it'll go up a little bit higher, measure that against what the theta is going to be. Because if you think it's going to go up, 10 cents in the premium and you're going to lose 8 cents to theta, well, you're only going to gain 2 cents. And is that 2 cents really worth it at that point? Or should you just take what you got now? All right. So it's a quick way to tell you how much you stand to lose between now and expiration. Vega. This is where implied volatility matters. Vega tells us how much our option price is going to move when implied volatility moves 1%. If we went back to those graphs that I had up earlier, sometimes you'll see they move 10% on the implied volatility in a couple days. That can be quite a bit out of your premium, added to or taken from your premium. The more time, the greater the sensitivity to volatility, meaning the higher Vega is going to be. And if you think about it, if you tried to estimate what Apple's price is going to be in 10 months, we would have a much wider range, much bigger numbers than if we tried all to estimate what it's going to be in 10 days. Because it can fluctuate much longer over longer time. And because an option has a wider range of fluctuations, the option market charges you for that. And they're more sensitive to the movements. So long options have positive Vega, and this is where your implied volatility really can either pay you or hurt you. Gamma is the delta of delta. Gamma tells us how much delta moves. It tells us how much delta moves for a $1 rise or fall in your underlying equity. So you can get a quick sense of how much you can stand to make or lose by looking at gamma and delta and adding them up and then multiplying them by the move. But adding delta up, multiplying it by the dollar move, adding gamma up, multiplying by the dollar move, and then adding the gamma and delta sums together. But let's just say you had a stock price that was 10, a delta, a premium then for that was 1, a delta of 0.5, and a gamma of 0.1. There. Wow. All right, there we go. Now, so if the stock price goes to 11, well, our premium is then going to be what? Delta tells me it's going to be $1.50. Gammy. Our new delta is going to be 0.6. How did I come to that? I took the delta from before and I added the gamma to it. Gamma does not remain constant, by the way, but it doesn't fluctuate a ton. And for this purpose, we're going to keep it constant. And I never try to anticipate gamma fluctuations. I just look at it and try to get a sense of how much my stock is likely to, or my premium is likely to accelerate. If we're at 12, now our premium doesn't go up 50 cents. Now it goes up 60 cents. Oops. So now it's 210. And our delta is no longer 60 cents. It's now 70. So on and so forth. So if we went to 13, we'd be up 280. 280. So for a $3 move, we'd make $1.80 on our dollar in my made-up example. But that's a quick way to get a sense of what's going on underneath the option. Any questions on these Greeks? No. All right, let's talk about long and short calls. And then we'll talk about long and short puts. So actually what we're going to do is we're going to talk about long calls and short puts. We'll tackle the bullish ones, and then we're going to tackle the bearish ones. So bullish strategies are going to be long calls, short puts, and then their spread counterparts. So bull call spreads and bear put spreads. Now I have an example of long calls up here. I just picked out a couple, one at the money, one in the money, one out of the money. I wanted to give you a sense of how things look. I then tacked on the Greeks to the bottom of them. At the money, by the way, your Vega and Gamma are highest at the money. All right. As you go in or out of the money, they get lower. All right. So Gamma, they're highest at the money. Most of the Greeks are most sensitive at the money. You'll see in the money, higher delta. Out of the money, lower delta. At the money, near 50 delta. Now, the difference in the money, at the money, out of the money is the cost. In the money costs more, which means your risk is higher, because as a debit trader, your cost is your risk. So higher risk in the money, lower risk out of the money. For that change in risk, you get a change in break-evens and probabilities. Your in-the-money options are going to have lower break-even numbers and higher probabilities of profit. Your out-of-the-money options are going to have higher break-even numbers that are farther from current price, and lower probabilities of profit. Probability of profit tells us what percent of prices inside of a 1 standard deviation move, inside of the expected move, what percent inside the expected move will be profitable at expiration by at least a penny. It's not the probability you're going to hit your price target. It's the probability that you will make at least 1 penny, and it is purely statistically calculated. It has nothing to do with Chaikin analytics, bullish or bearish, or whether something's overbought or oversold or anything like that. Now, I tend to, for my swing trading of options, I tend to go with a slightly in the money farther out in time. I did a video on options play. You can find it in our tutorial section. That and where you can find the recording of this later, I will show you at the end of the session today. Now, for long calls and short puts, we want to look like this. These are our best practices. We want good money flow. We don't want the stock to be overbought. When stocks are overbought and they're at their upper band, odds are, and we're playing the odds, that's what we're doing. Upper band, overbought, likely moves are lower. So we don't want to do long calls or short puts, any bullish strategy. We don't want to do those bullish strategies when we're overbought or at the upper band. We also want to see a bullish power gauge and positive relative strength. Now, this morning, John Schlitz wrote about, oops, oh, these are all long puts. We'll get to those in a second. John Schlitz wrote about Tyson Foods. All right, you got a pullback, you have a relative strength signal, we're oversold. This is what a pretty good setup looks like. So let's look at the options on this. The expected move. So I go through this entire thing in a tutorial video, so I'm not going to go through it all now. But what I'm going to do is we're going to take a look and we're going to set up a couple different bullish strategies so you can see the difference between them. So first, let's pick out their default, which is one strike in the money, one expiration out in time. And let's compare that to buying the March. We'll just go one farther out. Oh, they don't have it. Oh, yeah, they do. Oh, we go from, wow, quite a jump. All right, well, this will show us how time works. So same strike, different time, and then let's make this one a different strike. We'll go out of the money with this one. Out of the money would be, yeah, like an 82.5 call. We can even go a little bit farther than that. Let's look at the 85. All right. You can see they don't like out of the money options. Very low odds of success. Their default, again, is one strike in the money next month. This one they like the most. That's the one where I just added more time to it. If we look at these, you'll see this one is by far the cheapest. Also has the lowest odds of success. For our extra 90 bucks, we get a lot more time. We get 114 days versus 51 days. All right, you can see that down here, 114 versus 51. The break even on this is lower, but we have a lot more time to get to 85 here. The probability of profits are about the same. They like this one slightly better, probably because the target is slightly farther away. They base their targets based on right here. This is the expected move calculator. You can pick the trading rate, the time. The farther out in time you go, the wider the range. The closer in time you go, the more narrow the range. But you can see the February 16th 80 call, they're using 89.36 as their profit target. One standard deviation move higher, right here. They're going to use in this calculation, the April target is 91.97. I get a lot of questions. Why are the puts better scored than the calls? Well, it's because they make an assumption in their trading range that moves lower will be bigger than moves higher, and that more prices will exist lower than higher. Which is to say, there's an old adage, you'll see they have, here's your at the money line, right? And they say that within one standard deviation to the left, that number, that percent of prices exists there, where only this percent of prices exists to the right. This is getting a little bit in the weeds on statistics. They skew left. Therefore, you have a slightly farther away number. Therefore, you have a slightly larger profit. Therefore, your risk reward is slightly better on the puts than the calls. Therefore, they give them a higher score. It's a lot of therefores, but that's how it works. Now, on the very first page, it shows you your returns. Out of the money option, you'll see, look at that, has a much higher chance of return than this one does. Now, for both of these, is the out of the money for they're the same. Yeah, we're looking at the same expiration, the same date. So they're looking at the same price target for both this one and this one. These have the same price targets. They're both using 91.97 for either of these. Let's change that back because we don't want that. There you go, 89.36. All right, 89.36. This one still has a higher profit. Out of the money options are more leveraged. They have a lower delta, which means that you don't make as much off the bat. In fact, if we slide this down, you see, if we just go down to 86.94, this makes a lot more money than this one does. But as we go farther in the money, eventually the out of the money one accelerates and is better. You can even get a sense of where that number is, right? Wow. Oh, there you go. That's the difference. If the price goes to 88.78 at expiration, you're out of the money. One is better. If it goes to 88.77, you're in the money. One's better by pittance, by pennies, right? Um, Out of the money options, they make more if you get a bigger move than in the money options. In the money options, will not lose as fast though. So if we don't go anywhere, if we barely move, you'll see this has a very little return. This one's gone. That's it. And you can see even as we go back in time, even as we get closer to now, small moves are going to favor in the money options. Really big moves favor out of the money options. I like to trade slightly in the money, as I said. All right. So for me, if I'm looking at setting this up, I'm looking at a call slightly in the money. I'm looking for a target up here around 85, 86. I like to target just above the upper band. So this is somewhere my target would be somewhere up here. I add a couple percentage points to the upper band. So the upper band is at 85.22. So what would 2% be? $1.60. So let's say 87 plus as a target, a little over 87 as a target. All right. Oh, also on the front page, they list the implied volatility. Here's your volatility range. I don't rely on this. I just don't. I'm using the volatility that I find on my broker. One, this has a slight delay to it. Standard delay. The options play screen just has a standard delay. But that's how I do it. So if I'm looking, at something like this, I want to go farther out than I think it's going to take, and I want to go slightly in the money. So I would start looking at the 81s, maybe at the 78.5s. It depends. I want to see that I have a chance to make a buck for every buck I risk at least. What do I mean? Well, if this gets to my target of, let's say, 87.50, and it does it, in the next couple of weeks, do I have a chance to make at least 100% on my money? And this is suggesting that on this trade, I don't. It needs to go a little bit higher. It would need to get to like 88 for me to double up on my money. And 88 might be a little bit higher than where I had targeted 85.22. Yeah, I'm looking at about 87 to 87.50 for a target, about 2 to 3% higher than the upper band, a couple percent points higher than the upper band. So to me, this is on the line of whether or not I'd be interested in doing this, just based on the risk reward. Right? For every time I buy an option, I want, if it makes the move I think it can make, if it hits my target, I want to be able to double up. I want this to say at least 100% return by the time I'm willing to do it. And it's not usually by expiration. I want to be out a month before expiration. So that would be by this, was it the 16th? So 9 to 2nd be 2. 3, 4. There you go. So if I got to 87.50 or even 88, this doesn't quite look like something I'd like. Now, other people may be happy with 50% gains. I think you should have rules for taking profits. Every trader, option trader, should have rules for taking profits. It's what keeps you from getting greedy. All right. I have a rule where if I ever double up, I take half of my position off immediately. Simple rule. All right. So that's it. On this is a pretty good setup. This has all of the characteristics that we look for in terms of best practices. Power gauge is positive. Relative strength has been strong for a while. We're oversold. It doesn't necessarily need to be oversold, but I prefer to be oversold. I like to buy when we are at or below this middle dotted line. That's my rule. That's Josh rule. That's not a Chaikin rule. That's a Josh rule. I put rules around my trading so I'm not emotional about it. So I don't hope or think something's going to happen. I put limit orders in to take my profits. So I think those are things that every options trader should have. They should have profit targets, whether you want to take a quarter off at 50% and half off at 100%, or just take everything off at 50%. If you're doing advanced option strategies, I often tell people take it at 50%. If you're doing ratio spreads or butterflies or condors or things like that, I encourage people, advanced strategies, take it at 50. Credit spreads. So this is a bullish scenario. A simple bull, a simple call. Actually, before we move on to the bull puts, let's look at if we were doing a call spread. So the call spread, the advantage of the call spread is it reduces our initial cost. Okay, so if we look at, and I just reset this to the defaults again, if we look at their default buy, it's going to cost us $430. We have a 34% chance of it being profitable. Our break even is $84.30. If we just sell the 90 call, then we reduce our cost by 65 cents. It's pretty good. So now our cost is only $365. Our reward is $635. Remember, I wanted a 1-to-1. This is why spreads are pretty good. They give you great risk reward. Look at this. If you do this spread and it reaches 90, you're going to do amazing. Even if it reaches 88, you're going to do pretty darn good. All right. Now, the farther it goes, the more you'll make because you profit off of time decay. But when you hit your credit leg on a vertical spread, I usually encourage people to take their profits. So you should be placing your credit leg at your profit target. I would not be doing 90 because I don't think it's going to get that far. I would do 87.5 probably. That's where I would look. And we can compare these actually. Now, there's a question about why do they have such wide debit spreads? So first off, options play is not Chaikin Analytics. This widget here is not us. Developed by a third party. We like them. Optionsplay.com are great partners with us. They've got a really cool tool, but it's not ours. They set their credit legs at the 1 standard deviation move. So 89.36 is where the 1 standard deviation move is. So they said, what's the closest strike to that? It's 90. So that's why they had the 10 wide spread. The 87.5 gives you a higher probability of profit, but for the less risk, the less cost, you don't quite get as good of a reward. In fact, you're reducing your reward by $200 when you're only reducing your risk by $50. So even though my target is closer to this, I would more likely do the one in the middle, simply because the risk reward is better. Although this risk reward is good. I have a chance. I'm going to risk $315 to make $435, 40%. That's pretty good. That's about 150% at expiration. Right? If it makes it all the way up to, now they're using for these numbers, max reward, they're using at expiration. They're saying if it goes all the way to expiration, you would max out. All right. And you can see pretty good return, 138%. If it does get to 90, then the one in the middle is going to be worth more, 173% return. If it gets to 90. If it only gets to 87.5, that's where I think you can go, then I'm better off doing this one on the right, even though this one gives me a little more upside. So you have to balance how much upside you want versus how much risk and reward you want. And you have to kind of come to where your balance for that is. By the way, on verticals, I never trade a vertical with a POP less than 35. I really want them to be, I never trade a single less than 35. I never trade a vertical less than 40. So for single calls, I want them to be above 35. For verticals, I want them to be above 40. So this is kind of the minimum of where I like. So this isn't quite the setup that I like right now, but that's okay. If you want, you can be maybe a little bit riskier. It'll get you to more trades. You could do a minimum of 30% on the singles, a minimum of 45% on the verticals, but you should have some, again, you should have rules. They make it easy to determine what you're going to do. I used to have a flow chart when I first was learning and trading options. I literally had a flow chart. Is implied volatility in the upper or lower end of the range. Upper end of the range, credits. Lower end of the range, debits. Go down debits. All right. Debit strategies. Am I bullish or bearish? I'm bullish. Okay. Here are my set of bullish low vol debit strategies. Great. Is the risk reward? And I would just go through just check them off and go down my flow chart until I landed on, oh, I should be doing the single call. Or, nope, I should be selling the put spread. My flow chart told me. Now it's all in my head because I've been doing this long enough. But you should have a if this then that approach to trading options. All right. If this picture did not look the way it did, I would not buy it. But it looks like a good picture. So verticals reduce your risk, increase your potential profit versus that risk, increase your reward. What they do is they give up the upside. So if this goes to 100, if this really takes off and shoots all the way up to 100, well, the verticals are going to really stop gaining for you at a certain point. Not exactly at the short leg. You can still profit past the short leg, but it's going to slow because eventually the deltas on both of them are going to be 1. And for every dollar you make on the long call, you're going to lose 1 on the short call. The reason the vertical works is because the long call, slightly in the money, has a delta of like, what, 0.5 or higher. And the short call, all the way up near the upper band or higher, probably has a delta of 0.2. So when we go up a buck, your long call makes more than your short call loses. And this works for a while. I encourage people to take their profits when they hit the short leg or just slightly above hitting the short leg because you can profit a little bit past that. I don't care how much time you have left. You're not doing a debit vertical to profit off of theta. You're doing a debit vertical to profit off of the move. And so, don't think, hey, if I just wait another week, that I can get this theta money too. Well, you might get that theta money. The stock might also go the other direction and you lose the all intrinsic value money. Intrinsic value money trumps theta money almost every day, almost every time. Right? So, money flow decreasing. No, I'm not concerned about money flow decreasing on this. It's still staying positive. In fact, it's made a decent move back. It's made a 5% dip here. In other dips of that sort, we saw money flow go negative ahead of the next move up. Right? Price dropped, money flow dropped, and then everything came back. Pros got to take their profits too. Sometimes that shows up in money flow. Right? If a stock is down 5 to 8%, I don't know about you, I sure as heck didn't knock it down that much. I don't have the capital to do it, but institutions do. And money flow tracks institutional activity. And so if a price is down a whole lot, then it's not unreasonable to see a little bit of red money flow. So that would not cause me to panic. This is actually pretty good because not only has it come down from outside the upper band to the middle line, but it's done so without actually dipping negative. So I'd say that's honestly modestly bullish in terms of what you're seeing in current money flow. And the other thing we look at for money flow is persistency. And you'll see that on the move up, we've had a healthy amount of money flow on the move up, which is good to see. So. All right, let's say we wanted to sell a put or a put spread. So I'm just going to convert these all into short puts, bullish strategy, short puts. And let's look at them at different. So at the money would be about an 80. We could go a little bit farther down. Where's the lower band? The lower band is at 78.96. So let's put one right outside the lower band. Should be this. One at the money, and then we can do one even farther away. $72.5, which is way down there. $72.5 is down here. All right, so we have three different scenarios. One where we're selling a put at 72.5. One where we're selling a put at 77.5, right outside the lower line. And one where we're selling the put right at 80, near at the money. Now we're doing these all for 51 days out. I don't like to sell that amount of time. I try to keep it at 21 to 35 days, 3 to 5 weeks. Why? Theta. Theta's going to be roughest there. Let's do 30 days. And let's look at these on a 30-day example. All right. The closest to the money has the least probability of profit. It's also going to have the lowest score. Yeah. Why? Well, you get the most money, but you have the least odds of success. And because the risk is pretty large if it goes against you, credit strategies, you're going to want higher percentages. You want higher odds and lower money, generally speaking. Now, in these strategies, you would have to put aside $7,800 to make 45 on the 78 put. You need to put aside $8,000 to make that 90. And you need to put aside 7,500 to make that 10. Now, 75 put. Oh, we did 75, not 72.5. So this line should be right about here. That's pretty far down. That's down near our long-term trend line. Very low odds that we're going to get down there and then close below that in the next 30 days. So you see the probability of profit for that is incredibly high. Option play happens to like that. I encourage people to, when they sell puts, to do it when the stock is near the middle line, at or below the middle line, and then to, depending on how aggressive you want to be, if you sell, I encourage people to do it just at or outside the lower band. That's the expected range. It's unlikely to stay below that. If you look at this chart and you sold every time it was oversold and below the middle line, you sold at the lower band. The last three would have worked out beautifully. All right. Tapping that band, oversold. Tap that band, just barely oversold. Here we didn't even quite make it to oversold, but we tapped the line there. Just at oversold. All those would have been great credit strategies. Short duration, couple weeks, take your money, be done. I encourage everybody to close their shorts early. Do not wait for expiration. Do not be the person that calls me and says, Josh, I don't know what to do. I had 3 days left yesterday, and I sold it for $1 and it was only worth 10 cents. And then today it just gapped higher because some analyst came out and said that he thinks that Tyson Foods is going to buy Hershey Foods and that they're both going to be bought by Amazon. And so the stock price just went against me by so much. And now I only have 2 days left. What? Don't be that person. The person you should be is the one that when you get 80 to 90% in your credits, you just take it. And you don't care how much time is left. And you don't worry about that last 10% or 20%. And you pat yourself on the back for a great options trade, and you move on. I encourage everybody, when your options short legs get filled, shorts, when your credit strategies get filled, whether it's a credit vertical or selling a put, when they get filled, put in a limit order to close it out. So if you sell it for $1, sell to open for $1, buy to close for 20 cents or 10 cents. Sell to open for 40 cents, buy to close for 5 cents. Something like that, somewhere around the 10 to 20% left range. When you've got 80% profits or more, take your credits off the table. If you don't take your credits off the table and there's only 3 days left and you're up 90% on that credit, and you say, you know what, I'm just going to wait those 3 days, I'll tell you right now, even if you're right and you get that 10%, you're being greedy. And on the long time frame, it's going to hurt you. It just is. I can't tell you how many people I've coached that that their trading profitability has changed simply by buying back their shorts and not waiting for expiration. It's mind-boggling how many people I've helped, but just by telling them that one little thing. And maybe that's for you out there. Maybe that's not what you need. Maybe you're already doing it, but if you're not, in the strongest way I can say, without telling you, because you're all grown-ups, you don't need to tell you what to do. But please buy back your shorts. It's better. All right. I can send you my slides. I don't mind doing that. Anybody that wants these slides, email support. All right. So there you go. All right. Let's talk about credit spreads, which is, if you have the ability to do this, this is a way to leverage your money on the credit side. So we're going to take these exact ones here. And actually, we're going to get rid of one of them. And we're going to add them. We're going to turn them into credit trades. So let's take the 80. We're selling an 80. We're going to buy a lower leg. So in this way, we turn our credit spread, our credit, we're just selling. So instead of just selling the put here, we're now going to sell another put a little bit lower. And now we got a spread. Now the beauty of the spread is the risk is a lot less. So we're buying the 80. We'll do them too wide. All right. So we're selling the 80 and we're buying the 78. And on this one, we'll do the 75 and we'll buy the 73. Which I can't imagine. It doesn't even have any. So we'll do the 78 by 76. There we go. All right. Versus just selling the 78. So if we sell the 78, $45 in our pocket. All right. If we sell the 78 by 76, we only put $25 in our pocket. We lose 20 cents on that. Right. This is where we just sell the 78. This is where we sell the 78, but also buy the 76. Now, our cost has gone down. Instead of making 45, we're only making 25. But check out the risk. On this one, you need to put up $7,700 to make $45. On this one, you need to put up $175 to make $25. All right. They might actually make you put up the full width of the spread. They might make you put up the full 200, but you're really only risking 175 of it. So in this one, your broker's going to say, okay, you want to take in $45? Here you go. We're going to put aside $7,800 from your account. On this one, they're going to say, hey, you want to make $25? Fine. We're going to put aside $200 from your account. Now, think about it. $25 on 200 is what percent? It's pretty good. It's over 10%. So you have a chance to make 10% selling the 78 and buying the 76. 10% on your money in 30 days. Think about if you could do that every 30 days. And you're going to be right more than 4 out of 5 times. Just statistically speaking on that. Now, when you go closer to the money, you make more, right? So instead of the 78, 76, you could look at the 78 by 80. That you get $20 more. And it's the same risk. Or sorry, it's the same. They're also going to keep $200 from you. Your risk is a little bit less. But look at your POP. Really drops about 14% on that. So it's way more aggressive. But listen, $45 on 200 risk That's pretty good. That's 20% in a month. So you have to kind of decide where you fall at. Again, for these spreads, I look to sell them when we are oversold, positive Chaikin credentials, so bullish, positive relative strength, solid money flow. Oversold, I like it when we're at this middle line. That's where I shoot for it. I encourage people not to do it when we're up at the upper band, not to do it when we're overbought. Sure, there are times where this happens, where you have a case where you go from overbought to oversold, and you just stay outside the upper band for a little while. Eventually, these things are going to resync up. And more often than not, when we go to oversold, you get a good pullback. All right, this one wasn't even that big. But if you're doing it up here at the top and you're selling, this is harmful. Down is bad. So we want to try and catch it when it's already on that pullback, and that's where you want to sell the put into. All right, let's talk about bearish stuff. Can I talk about rolling a spread if I think it's moving my direction? Yeah, sure. I don't normally roll, to be honest. I don't do a lot of rolling of stocks. What I find to be my preferred way of doing it, rolling is where you take your position, maybe you're short this spread here, and as the stock moves up, you then roll the position, you close this one out, and you open a new one. And then now maybe your spread's up here. And you do it all in one fell swoop. You close one and you open another all at the same time. It's called a roll. I don't typically roll any of my positions at all. The reason for that is I have specific rules for when I roll and why. And I will roll if the new position meets my criteria for opening a new position. That is to say, if we are oversold and I enter here and then it goes up and pulls back and I have not exited my trade yet, right? So if I entered my position here and it came against me and then went up and then came down, and now we're sitting here and I have not closed my position, then I might roll it from here to here. But only because my rules are met for why I would enter this position in the first place. So I only roll an existing position if it would meet my rules for a non-existing position, for a new position. If I were willing to take that position as a brand new position, then I'd be willing to roll it. Otherwise, I have no interest in rolling. Oftentimes, what happens in rolling is you keep rolling. You have to keep rolling. You're defending your position. So you sell the put, you sell the put, and it goes against you, and now you roll down and out to not take that loss. It's a way to avoid taking a loss, which is fine. You also have to consider, if you're doing big volume, that might be worthwhile. If you're not doing huge volume, dozens of contracts, then you have to consider, if you roll this now because you're in a bad position, is the new position really a high probability position, or is it a position you're taking to bail yourself out of a current position? And compare that to taking the loss and then going and finding a new position that is going to perform better than forcing yourself into a position that's maybe okay, but you want to take it because you don't want to take that loss. If you don't want to take losses ever, then you're human. If you do everything you can to avoid taking losses, doubling down, constant rolling, you're not going to make as much money as you could if you just accepted the fact that you're going to have losses in trading. Anybody tells you that they win all their trades is anybody I would never trade with. Ever. because you're going to take losses. It's just part of the game. So for rolling, if it meets my criteria for entry, then I'll roll. If it doesn't, then I have no interest in it. I'd rather take my loss and move on. The biggest thing that I was taught by those floor traders was mitigating and managing your risk. It was less about how market making works, right? The market makers and the floor traders, most of what they told me was have rules and manage your risk. And then we would talk about the option mechanics. But before we got to any option mechanics, it was have rules and manage your risk. So I have rules, and I will not roll in no. So Scott, when you roll, you are not necessarily gaining additional revenue on the trade with the same risk probabilities. It's a brand new. That's the thing. It's not. It's going to have its own profile. It's going to have a brand new profile. It might. There's a possibility that when you roll, you could gain additional revenue on the trade without the same risk probability. But you're closing one position and opening up a new one. That's all you're doing when you roll. You're just doing it in one fell swoop. So usually you're not necessarily just gaining additional revenue. You are taking in revenue to cover a loss, or you're closing a winning position and opening up a new position with the expectations that you'll win some more. Those are the reasons you would roll. Now, there are times where you roll for time reasons, okay? But I try to time those. That is to say, there have been times where I have bought 90 days out, and the stock, I bought it when it was oversold, and the stock didn't quite make the move I wanted, and now it's oversold again, and now I only have 50 days left. So maybe then I roll because I want to gain more time. I'll roll to buy more time. Usually it's additional cost to me. It's additional risk, not additional reward. But no, when you roll, you're not necessarily getting the same risk profile or necessarily additional revenue. I mean, usually you're getting additional revenue if you're rolling credits. If you're rolling debits, you're putting out additional risk, or you're changing the risk. So I hope that helps. Let's talk about, holy cow, it's already 1 o'clock. I'm sorry, folks. I'm very talkative. I get very passionate about this option stuff. Well, let's look at some bearish stuff, and then we'll call it a day. We'll see if we can get done here in the next 15 minutes. For the bearish stuff, again, it's just the opposite of the bulls. Right, so you're in the money are going to have higher deltas. You're out of the monies are going to have lower deltas. If it makes a big move, you're out of the monies are going to do better than the in the money ones. So here's Priceline. Priceline is a pretty big price stock, but we have a pretty good setup here. Actually, we have a stock that's bearish that has negative relative strength. That is negative money flow, is overbought, and is just bouncing off the upper band. That's usually where I like to enter, right? In this case, we don't want to be oversold. If we're taking bearish positions, we don't want to be oversold, and we don't want to be at or outside of the lower band. Typically, when we get at or outside of the lower band, even in a bearish stock, which is going to continue to make lower lows, you can see we get outside of the band, we pop, right? Oversold, pop. Oversold, pop. So you don't want to take your positions when you're oversold. We are not trying to bank on, I mean, maybe you want to do this, so that's up to you, but I don't like to play the, hey, we're here and let's just see if I can run this thing up, right, as this runs up. That's not what I like to do. I encourage people to take bearish positions, not when we're oversold, either entering overbought or leaving overbought, not to do it when we're down by the lower band, do it when we're at or above this middle line. Now, we could buy a put. You could do at the money, you could do slightly in the money, you could do out of the money. These are going to be pricey puts because it's an $1,800 stock, but they should be pretty liquid. All right, so here's your 1760 put that's just slightly in the money. All right, $4 in the money. It's higher than current price, slightly in the money. We could do just out of the money. And in that case, we would be buying, let's say, a 1740. Or we could go slightly in the money or deeper in the money. Let's buy a 1780. Woohoo. Pricey in the money. All right. You see, they like the in the money one the most. Right. Costs the most, but has the highest odds of success. The reward also is the most because it can drop the farthest, but highest odds of success, but it costs you more. If we go back, you'll see the one out of the money, highest potential return. Again, the farther out of the money you go, the more leverage you're getting. Even though the delta is lower, if it makes that big move, gammas are going to change that delta. That delta is going to move up, and you entered it on a very low number. So there you go. Verticals. So on a vertical, again, we want to set our short leg near our target. In this case, our target would be, just like I do on bulls, up above the upper band. This one would be slightly below the lower band. So in this case, the lower band is around 1688. So 2% lower than that would be about $30, $35 lower. So let's just say 1650 would be our target. Now, when you do a vertical, a debit vertical, don't go deep in the money. The short leg of the debit vertical is going to help you by offsetting the premium. You get the same sort of probability increase of going in the money without having to go deeper in the money. So I wouldn't go deeper in the money, just one strike in the money for if you're doing debit verticals, one strike in the money. And then again, short leg at your price target. Which actually was, I think, 1650. There you go. And we're selling that one. All right. Do the same thing with this one. All right. And there you go. You can see the risk for the one is about $1,000 more. The reward is about $1,000 less. It's the same width in terms of, this is 130 wide. There's only 110 wide. All right, your odds are higher for this one than this, but both have pretty good odds of success. Either one of these is going to have a good score. Look at that. Not a bad trade. Versus the score without the vertical, not as good. All right. So that's the 1760. There's all 1760. The middle one I just added a short leg to, and look how much it changes the score, and the probability of profit goes up almost 5%. Means 1 in 20 more will work for me than it didn't. Also, my risk reward is a lot better. A lot better. Over 200% on this. All right. If you were going to do credit spreads on these, same thing as the puts, put spreads. We just do it the other way around. I like to do it again at the band. So if we're doing a call spread, again, we want the same bearish setup, but I want to put my, at least here is the closest I would go, is that upper band. And then you can determine how far above that you want to go. We didn't really talk about the width of the spread on the put side, so I'll talk about it here a little bit on the call side. If we're going to be selling calls, so let's set this up. Let's do it 1800. Let's do 1800 and let's change the widths of them. So call. We are going to sell the 1800. And we'll do buy the 2080 on this one. Oh, sorry, 1780. Nope, we want to buy the higher one, so 1820. There we go. All right. In the middle one, we're also going to do the 1800, except we'll do the 1840 instead of 1820. So call. Sell the 1800. And then we're going to buy the 1840. And we'll just make this one 18 by 19. So again, we're selling the 1800. And we're going to go all the way to the 1900 for this one. There you go. All right. And then you can see the difference. The odds of success for this, these two are pretty close. As you widen it, your probability of profit goes up slightly, but the amount that you risk increases, right? So the one on the left, because it's difference of 100 strikes. Now again, this is a big stock, but that's a 10,000 risk. Whereas the one that only is 20 wide, that's only a 2,000 risk. All right. Now on this 10 grand, we're going to take in 2,300. That's 23%. On this 2 grand, we're going to take in $720. That's a lot. That's like 34%. For 51 days. Let's see what we can do on 30 days. 520. That's still a lot. That's over, geez, on 2 grand. Holy cow. That's like 25% on 2 grand. You can take in a month. That is why these are income strategies. You got almost a 3 out of 4 chance of that working out for you. Manage your risk. So you're not taking max risks. And these are going to be some nice, easy trades. Now, this one is going to be 40 wide. So that's 4 grand, but you're taking in 1250. Also about 25% on that. A little bit more. Oh, wrong expiration. But you can see the spread, so 900 on 4 grand. That's still not too bad. About 22%, 22.5%. Right? It's 25%, 22.5%. This is 23%. These are pretty big percentages for 1 month of work. So this is why professionals really like credit spreads. The floor traders and the market makers that I learned from often were spread traders. Because they did a huge volume, they typically kept a net credit book. That means they did more credit trades than debit trades, but this is one of their preferred ways of doing it. I encourage people to really go out of the money on these. Look at 30, 20 deltas for the short leg, somewhere in there, especially if you're new to them. If you're new to them, that's the way to go. Out of the money, low deltas. The way to manage these should be the same. You sell this for $520. You take in $520 on this spread here. You should be closing it out for, when it's only worth $100. And take 400 out of 500. That's 80%, and buy yourself something nice, or pay your mortgage, or whatever you do with the money, or just look at it and go, I did this with Chaikin Analytics. Pretty cool. So that's just prudent management, is making sure that you have a good exit strategy for this. Okay. All right. Well, with that concludes today's session. If you'd like to watch a recording of this lengthy session, you can find it in our resource center. Our resource center is available by clicking on the stack of books in the upper right-hand corner up here, near where the little gear is, just to the left of where your icon is. We click on product resources, and then we can go down to the resource center. It's going to open up a new tab for me. In here, we have 2 sections of recorded videos. So I'm just going to scroll down. The first are our Chaikin Analytics tutorial videos. We have a couple that we just put up front, but you can view the full tutorial playlist. That is not where you're going to find the recording of this section, but it is where you're going to find the walkthrough of options play. First one in there. You'll find the recording of this under subscriber-only education, under the View All Past Recorded Sessions. It'll be listed here later today, right on the top. You can also go back and see previous sessions I've done. Here's Class 1 Basics from last week. You can scroll back and see previous sessions. There's one of the advanced ones I did, and there's the last intermediate I did. This will be available there. So thank you, everybody, for hanging out with me. If you would like a copy of these slides, I'm more than happy to provide them. I didn't do much with these slides today, as you can see. But if you would like these examples and these slides, then by all means, email me. Where do you email me at? support@chaikinanalytics.com. Email me, say, Josh, I want those slides, please. Next Wednesday, January 3rd, 11 a.m., we will do our options session, advanced. Happy New Year, everybody. Hope everybody had a good Christmas holiday. And please reach out to us. Support at chaikinanalytics.com if you'd like the slides from today, or you can call us 877-978-6257. Happy to answer any of your questions that I was unable to get to today. Thank you all again for hanging out, and I look forward to seeing you in future sessions.